everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today marks another Fed Friday, where I go over the recent news about the Federal Reserve and what's changing with it or what's not changing, and the implications that that will have for the future, since the Federal Reserve is a very important thing in our financial markets, especially now. I'm not sure if I'm going to keep doing this series for the long term, so if you like it, be sure to hit that like button, and also be sure to leave a comment below if you like this sort of series, you like the direction it's going, and I'll be sure to do more of them in the future. But without further ado, let's get into it. So this is an update about what the Fed is planning on doing for the coming future, and it's largely the same as what they've been saying they're going to keep doing for the last almost year now. They are planning to keep money very easy. They're going to keep buying bonds, and they're anticipating having to buy many more bonds in the near future because of the ever-changing pandemic. And things aren't looking very good right now because cases are rising, and they see that as a very big risk, naturally, since it's had a huge impact on the economy. But the Federal Reserve's actions have also had a huge impact, especially on the financial markets. They're the big reason that the financial markets are as high as they are right now. Investors are confident that they have the Federal Reserve as that sort of backstop, the buyer of last resort, if not the only resort in many cases, where the Federal Reserve will buy bonds and take away a lot of risk in the market to where the big risk is actually holding cash, since they're printing more and more money and devaluing the currency in order to prop up asset prices, which is not always a net positive. Inflation is not really a good thing in itself unless you are a debtor, and our system is filled with debt, and the Federal Reserve is a big reason that that is the case. It enables a lot of this debt spending and deficit spending, as I'll get to in a second with some of the other news. But the Federal Reserve is planning on having to buy more bonds in the near future. They've already been buying $120 billion in treasuries and mortgage-backed securities each month right now, so they'd be planning on bumping that pace up if we saw more problems with the economy. We saw the markets going down, because really, after all, what the Federal Reserve really means by the economic failures is the market going down. The market can't go down in a good economy. So they say that in order to perpetuate this system, they keep devaluing the currency to keep asset prices up and keep the financial markets high, because markets have to go up. There's no way that they have to correct themselves at any point. Bubbles are not a thing. We want to keep everything high and going because that's the only way that things can go. That seems to be the philosophy of the Federal Reserve and the government in general. We just look at the short term. We don't let anything correct itself ever, even if it might need to, and we just keep perpetuating this system with more and more debt and more currency devaluation. And the Federal Reserve is eager to do this, apparently. But like previous months, they've left it kind of vague, saying that over the coming months they could provide more detail in how they will adjust their bond buying program, since it kind of depends on what actually happens with the financial markets and the economy, because that could change. It also depends on what the government on the fiscal side, through Congress and the executive, what they're going to do with spending and appropriations. But in the end, the Fed says that economic forecasted risks are tilted to the downside, with the latest data suggesting an increased probability of a resurgence in the disease. That's the big risk factor. It's the pandemic that they're really looking at, when really a bigger risk factor that makes the pandemic such a problem for the economy is the amount of debt in it. So if you have any sort of short-term volatility towards the negative, that's a huge multiplier effect because of how much debt needs to be paid. And if you don't have money in the short term, you can't pay those debts, and it just kind of topples out over itself. So that's the big problem that they're trying to avoid. And the answer apparently is more and more debt, unfortunately, for a lot of people, businesses, and the government. But this isn't much unlike what the Fed's been doing over the past few months. They keep keeping things vague, saying they're going to keep rates low, they're not going to jack them up, they're going to keep buying bonds, and they are not going to stop being a backstop for the markets, because if they suddenly pulled the rug out from under people, you would lose it all, and the markets would topple over, because the big thing injecting confidence into them right now is the Federal Reserve and its pledge to continue these easy money programs. If you suddenly removed access to debt, or if you suddenly removed this pledge from the Fed to keep quantitative easing going, then all of a sudden you lose a bunch of confidence in the market. It's like pulling the chair out from under someone, or if you remove one of the legs, it's going to fall over. And one of these key legs is quantitative easing and keeping these easy money programs. So, of course, the Fed's saying they're going to keep them going, because if they didn't, the whole thing would topple over. In other news, likely President Biden has named Janet Yellen as his would-be Treasury Secretary. This would replace Steve Mnuchin, who is Trump's secretary, which I covered in last week's video. But Janet Yellen, for those of you who don't know, was a former Fed chair, the Fed chair under Obama, with really overseeing largely the same sorts of policies that the Fed is doing now. Lots of quantitative easing, very low rates, very easy money policies. So it's not like you have a lot of difference there. It's going to be probably moving the Treasury more in lockstep with the Fed, since Janet Yellen is kind of an insider. She was there before. She probably knows a lot of people in the Fed right now. She headed the Fed at one point. So it's not like she doesn't know anyone there and we have this independent Treasury, independent Fed. It's kind of like they're really moving towards one sort of central body that controls all the spending, or at least where money goes to, and then you have the Federal Reserve, which controls the money. If they're working in lockstep, you don't really have a lot of checks on each other. They're just one entity if this is the trend that we're going towards. Not saying it will actually happen, but it seems like a move towards that direction. And as a follow-up to last week, we know that Steve Mnuchin said that these emergency lending programs would end, but I'd imagine Janet Yellen and the Biden team and the Biden Congress, granted it does have a Republican Senate most likely, we're probably going to see a lot of these emergency lending programs get reopened, even though Mnuchin says that they're not going to be renewed in December. The Congress could always change that, though. You would need Congress to approve it in order for Yellen to basically redo all the things that the Trump administration did over this last year in lockstep with the Fed, and that Congress did in lockstep with the Fed. Again, it's this very reliant system where the Federal Reserve is the lifeblood of what Congress does with its deficit spending. If you removed the Fed from the equation, Congress probably wouldn't be able to spend nearly as much as it does, because it would need to actually sell these bonds to investors. And if you're just plowing all this debt into it with no actual way to pay it back, investors in other countries wouldn't buy this debt so readily. The only reason they buy it sort of now is because they know they'll get something back. But as you keep printing more and more money and devalue the currency, it's going to make bonds less attractive because you're getting paid back in less valuable dollars, and that's no good. The reason that people buy treasuries in many cases is because they're seen as safe. But if you keep just opening the floodgates of quantitative easing, you're just going to have less and less valuable currency, which makes the bonds themselves less and less valuable if you're getting paid back in dollars. We'll see what happens with this emergency program. It will be kind of up to Congress to actually extend these things, but I'm sure Janet Yellen would be all over that as well to make sure that the Fed carries out these programs. It can do a lot of things together. There's going to be probably a lot more coordination this time around, even more than we had in the last year, if we get the Biden presidency with Yellen as Treasury Secretary, and then whoever the actual head of the Fed board is. If it's not Jerome Powell anymore, which it might be, who knows, we'll see if Biden actually appoints someone else. Meanwhile, to illustrate how vital the Fed is to this debt spending system for governments, in particular state governments included, we have Illinois here set to borrow $2 billion from the Federal Reserve. Illinois, that state that I live in, that has one of the worst credit situations in the nation. It's terrible. Lots of debt spending every single year, lots of unfunded liabilities. So why not add more fuel to the fire? Let's get some more debts to pay for short-term operations. And I just love how this is characterized as a short-term solution. Is it really a solution to throw debt onto a problem when the real problem is the deficit spending that's causing the debt? Throwing more debt to enable deficit spending is silly. The solution needs to be for the spending problem, not to throw debt on it to enable more deficits. The deficits are the problem, but that's never politically feasible. It's never politically palatable to actually lower spending or raise taxes. That's something that constituents naturally get very upset about. People like getting money and they don't like giving money. So what do we do instead? In the short term, we just take out all this debt, and eventually that system can't go on forever. There are negative consequences with this sort of behavior, and we're going to see it probably sooner rather than later because of how fast things have accelerated this year especially. No guarantee, I'm no fortune teller, but that's what it looks like. But apparently the Federal Reserve had offered $5 billion to Illinois, but it so graciously only accepted $2 billion. But again, Illinois probably wouldn't be able to get any of this money because of how terrible its credit rating is. It's not a good state to lend to. If you wouldn't lend to a business in the state that Illinois is in, the actual physical state or the fiscal state that it's in, you would not lend to a business like that. Yet you have the Federal Reserve, which is willing to throw out $2 billion to Illinois to pay for operations with no guarantee that it's going to fix any spending problems. This is part of that perpetuating system where the Federal Reserve enables this reckless debt spending where governments don't have to be responsible with how they spend, since all they can do is just take money from the Fed prints it out of thin air, the Fed buys that state's debt, and the state gets that newly printed money to finance operations, and they don't really have to fix any deficits. What this actually does is it creates more inflation, makes the currency worth less, and that's great for debtors themselves, but it's not good for someone who doesn't have assets or who doesn't have any fixed rate debt. You run into problems that way because of inflation. The natural course of things, in a recession especially, is deflation. Things get less expensive. But we actually see the opposite right now, with a lot of that deflation being canceled out by all of this new debt and all of the new currency devaluation, often associated with that newly issued debt, at least on the government side. And Illinois is not alone in this. We're not the only state getting lots of money from the Federal Reserve buying their bonds. You're seeing this across the board. Illinois is just a pretty poor example because of how terrible the state is fiscally. But anyways, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot, especially if you found it informative. If you like this series about the Federal Reserve, definitely subscribe so you don't miss any new updates since I put out new videos every single week. And let me know in the comments if you do actually like this series or if you want to see different things from it. I'll definitely be willing to cover the Fed at any point since it's such an important part of our financial system. And check out my links in the description for free stocks from Webull and Robinhood. But until next time, take care.